This week's episode is brought to you by Capital Financial Advisory Group for all your retirement needs.
Well, folks, welcome back into the Financial Safari. This is the time of the show where I go out across the world to find someone who's made a difference to me, made a difference in the financial world, or just overall known for something in general. We've got a really good guest today. His name is Mr. Laurence Black. And Laurence is the founder of something called the Index Standard. And first of all, Laurence, tell folks who you are, and then let's get into what the Index Standard is.
Broadcasting from coast to coast, it's the Financial Safari with your host, Coach Pete D'Arruda. You'll hear from some of the nation's top financial professionals. So stick around and find out how to make it through the jungle of the financial world, right here on the Financial Safari.
Thanks, Coach Pete. It's great to join you today. So as I said, my name is Laurence Black. I founded the Index Standard, and I founded the Index Standard on the back of about a 25-year investment career. So I spent most of my career in investment banking. So I like to call myself a bit of a reformed investment banker. And you know, what I did in my career has really set me up for the Index Standard. So kind of began my career as a young risk manager. I got lucky enough, I became an emerging markets bond trader, kind of some wild rides in the Argentinian crash, long-term capital. And then actually I've spent the last 15 years developing and designing indices, which has been really fantastic because you get a lot of expertise in a little project. You might be building a value index. You might be building a REIT index. You might be building something with growth stocks or tech stocks. So it's so much fun getting exposure to all these different things. And then you get a really good perspective of what's happening across the whole financial market.
Yeah, well, when we talk about indexes, they're basically set up towards the safety of the consumer, so the consumer doesn't have to buy just one stock. They can buy a basket of stocks in that same field, basically. Is that what an index is in a nutshell?
Exactly, that is correct. You know, I've sort of seen one of my personal stories. My father in 87 put a lot of money into one stock. Kind of didn't go so well. So I'm a big believer in diversification. So, you know, think about the S&P 500. That's got 500 stocks, and it's usually a pretty diverse index. Last couple of years, we've seen it get a little tech heavy, but you know, that's the good way to invest because it's cheap, getting good diversification and exposure to lots of different things, which as an investor, that's what we all want.
So if you were an investor, let's say you could only buy one index. So you could either buy the Dow, the S&P, or the NASDAQ. What do you think would be the best one for the consumer to do? And I know this is a tough question and it depends on what year, but as far as diversification and long-term growth potential, which one of those three you think is the best?
I would go a third. And actually, I would add a fourth index. I would also add a little bit to the MSCI World. So the MSCI World is a fantastic index. It's got about 3,000 stocks across the globe, right? Like I've just become an American, so I love America, and the S&P and all the American indices are wonderful indices. Right. But you need to remember, right, Pete, they don't always go up the most. And they're not always the best performing stock, right? And it's incredibly difficult to pick which is going to be the best country each year. So it makes sense to have a little bit across of everything. That way, you know, if something bad happens, you're going to kind of get some solid returns. And that's what you want, solid returns over the long term. The compounding really helps you.
Isn't it funny how the Dow Jones Industrial Index gets so much attention and it's only 30 stocks?
You know, I so agree with you. I find that index frustrating because you're exactly right. It's only 30 stocks, but I don't know if you know, it's actually price weighted. So that means each stock is weighted by the price of that stock, which has no economic relevance. Like market cap weighting weights to the size of each stock, which kind of has a relevance, or you could equal weight, makes sense. But 30 stocks, price weighted, it gets far too much attention.
It does.
People should follow the S&P 500.
I agree, and I've been watching that. Now, when we talk about forecasting in general, why should we think about forecasting as investors?
Yeah, no, so this is something that we do at the Index Standard, and we've been doing it for the last 3 years. So my first kind of response when I think about forecasting is, let me ask you a quick question, Pete. When you're driving your car, which way do you look?
Frontwards, usually.
Exactly. We all look out the front mirror or the front, and we kind of have a little glance to the back, right? But in the financial industry, right, we are focused with looking in the rearview mirror. Like, you get these historical illustrations from the insurance companies. It's the last 10 years, right? And I'm saying, let's look out in the front mirror, because, if I've had a smooth road, that doesn't mean anything. I might be coming to a bumpy road, and vice versa. So what we do at the Index Standard with our forecasting, we're just trying to provide another tool to help people look forward, because that's what's coming in front of you, the future. The past is the past. That's done.
Yeah, and when you see the ads, a lot of times they all say, and even in writing or on the air or whatever, it says past performance cannot guarantee future results. Yet that's what a lot of folks use to sell financial products, is past performance.
Exactly.
So looking ahead, so your forecasting approach is making sure to make sure to look at what's happened in the past, but also try to look at what's going to happen in the future, right?
Exactly right.
Yeah.
So what we do is we actually take the wisdom of Wall Street. So we see what the smartest people in Wall Street are saying is going to happen across stocks, bonds, and equities. We pick up their forecasts, and then we apply it to all these indices that are being used in the insurance space. But let me just make one interjection. So, forecasting has been done for hundreds of years. You think about Charles Dow. He had something called the Dow theory, where he looked at 6 factors, and he was doing this in the late 1800s. Wow. Then you had Benjamin Graham in the 1930s, sort of looking at earnings and then discounting them to try and figure out what's the value of something. And then more recently, we've seen a guy called Robert Shiller, has his CAPE ratio. He forecasts the expected future returns based on that. And then also, we've had Jack Bogle, well-known founder of Vanguard. He would also think about forecasting using the PE ratio and dividends. And then Wall Street has been doing this for the last decades. So what we do is we go to about 35 investment firms, and we take all their forecasts across all the stocks, bonds, and commodities. That's step one. And then step two, what we do is we take each index and we do a sort of X-ray analysis. So we want to understand what's going on with that index. So we do an X-ray, and we do it across stocks, bonds, and commodities. So then at this point, we've got two things. We know each index, what's in the X-ray. We know each stock, what Wall Street thinks. We kind of bring it together in something called like a Monte Carlo simulation. In a simple way, you could think about it as a sum product, but we just apply the forecast to the weight of each stocks, bonds, commodities, the aspect, and then we can actually use that for each index, and we can then predict. We take the wisdom of Wall Street and we put it for each index, and we can help people look through the front mirror. Yeah,
it's a good way to, again, not depend on what's happened in the past all the time, because we're all going into the future, I hope, and we all have that friend that's always living in the past, but our financial products should not be. So, folks, we're talking to Laurence Black.
Exactly right.
We're talking to Laurence Black. He's founder of the Index Standard. And Laurence, let me ask you quickly, I forgot to do this at the beginning, what got you into this particular realm of the what got you into the financial world in general, and then what got you where you are right now?
Yeah. So, that's a great question. So I'd say my father was always interested in finance and stocks. So from a young age, I was kind of looking at options and on gold and buying stocks. And then when I was a young kid, I always wanted to be an equity analyst. That was kind of the glamorous position before Elliot Spitzer came in and crushed that. And, I was lucky enough to get into creating indices, because I love creating indices. I did it for about 15 years, and it's really fascinating. You're creating a product that you can try and help someone do better, but you're also creating a lot of different indices. So you're becoming an expert in a different field, and it's just really enjoyable, and you're helping people do better.
Yeah.
So that's what kind of got me into that. And then, one of the thing was I left my last position. I ran the Barclays Index Group for about 10 years. And then I left in 2019, and I started advising Robert Shiller on indices. But at that point, I had designed indices for 15 years. So I thought, I'm going to design more indices. But what I realized is there's more than 3 million indices out there today.
3 million. Wow.
3 million. And then number two is you get these indices that are using complex techniques like risk control, mean variance optimization. So, who understands that, right? So what we want to do at the Index Standard, we want to help decode and demystify these indices. So the way I think about myself, I'm sort of like a poacher turned gamekeeper. I used to build them, and now we analyze them.
Well, let me ask you this. So you've been around the indices. How have you seen the custom risk control indices evolve over your lifetime?
Yeah. Wow. It has been a tremendous journey of innovation. So as I mentioned, let's say 20 years ago, you just had the S&P, the NASDAQ, and maybe the MSCI emerging markets. Today, what's evolved and what we've seen is now you've seen a technique called risk control, which is really just aims to smooth and cushion. Then you have another technique called mean variance optimization, which is trying to find the best allocation for a certain number of stocks or underlying ETFs. And then today, we're seeing so much innovation. We're seeing the use of artificial intelligence. We're seeing the use of intraday ticks to kind of get more responsive indices. And then what we've seen in the last couple months is really we've seen a new technique where a lot of these indices have the ability to go short. So that means they expect the price of some of those assets to fall, and they actually will profit from that. So it's a really innovative space that we've seen, but it's got a little bit more complex.
Yeah.
But it's actually also good for the end policyholder as well.
Yeah. So the average investor is someone who, like the average person who buys a car, they don't really know how the engine works. They just want to know when they press the button or turn the key, they're going to get from point A to point B. So if someone's listening now or watching now and they're saying, well, gosh, it sounds real cool having these custom risk control indices, but how does the average investor get into these, or should they deal with a planner who basically uses this kind of forecasting methods to put a real plan together?
Let me answer that in two ways. So they have got complex, and at the index standard, what we do is we rate and evaluate them, and we do the forecast. So we want to help people do better. But I really do think working with a financial planner makes sense because of this complexity, right? So it's just become very hard to navigate all these different indices. Some of them we see today have got 355 pages of rules and formulas. Like, who wants to go through
Nobody.
that? So that's our job.
Yeah.
We do that, and we empower financial professionals with our solutions, and then they can help use that for the policyholder. Now, the thing is, everyone is different, right? Some people might say, well, I want to take a bit of risk, and I want to find an index that's appropriate for me. That maybe it's a biotech or an energy index that's very volatile. You might get a huge home run, you might strike out.
Right.
Someone else might say, well, you know what? I'm very conservative. I want something safe and that's just going to be very consistent. And then you might need a different kind of index, whether it's wrapped in a risk control feature or a low vol feature. So I think that's where a financial professional can really help the end consumer get the right thing for their needs.
We've got about a minute left, and I just want to ask you, because they're concerned these days, and everybody's trying to think about their financial plan, their retirement plan. Where do you see the financial worlds in the next 5 or 10 years? What do you think is going to happen here going forward with the inflation environment, the recession environment? How's the U.S. economy going to affect the world economy? And just your overall views when you go to bed at night and put your head on the pillow. What are you thinking about in the next 5 or 10 years?
Yeah, well, so I think I'm naturally an optimist, but you have to be sort of thoughtful as to what's going on. So a couple things. What I would say is, number one is, I don't think we're going back to a period of the low inflation of 2%. That was a wonderful period where you had increased globalization. China's population was urbanizing. You had a lot of cheap labor. Unfortunately, those days are gone. So I think we have to expect a period of, higher inflation and higher volatility. So number two is, I think markets are changing. We've had a tremendous run in the US with the last 10 years where the whole market has been driven by tech. So is that going to continue? I don't know 100%, but I think there might be some headwinds. So you think essentially big tech has really taken our data and they've exploited that. Now I think people are getting wise to that game. You've got a new lady at the FTC, a lady called Leila Khan, who wants to kind of clamp down on that. Right. So is big tech going to do as well? I don't know. So I think, why not be diversified? Think about like Asia. It's growing fast. China, the valuations have come down tremendously. Europe is in a mess, but you put some money in now, maybe in 10 years' time, it's done okay. I do like the US. I think you want to keep some money there, but I would say it's very hard to predict is what's going to happen, because the last 40 years are going to be very different to the next couple of years. So I think it makes sense to be diversified. You want to be in equities because of this high inflation. So that's kind of my thoughts there, Coach Pete.
Yeah, and I'd be remiss if I didn't ask your opinion on cryptocurrencies, because a lot of people are asking me about Bitcoin and all those. But just your quick opinion on that going forward.
Yeah, I think it's here to stay, number one. But, as we speak today in kind of summer 2022, what I kind of feel has happened really is a lot of the FOMO has come out of the market.
Yeah.
So that's fear of missing out. It was so hyped. And, we saw this tremendous bull market and then the crash. I don't think it's gone, but I think now we're kind of at a much better place. It's level set. I think some of these benefits, such as the blockchain, that's huge benefit. But I like the fact that some of the FOMOs come out and maybe it can actually develop as a very useful technology for us also. I think long term, it's here to stay.
Well, and I agree, and it's not going to be like the Wild West like it was. I think there'll be more regulation there, and there'll be some more that are crypto that's safer, more secure than just throwing your money against the wall and hoping it's here tomorrow kind of thing.
I agree, and I think regulation actually will help this whole sort of industry mature and grow into another proper asset class.
Well, it'll build confidence for the consumer too. We don't want too much regulation, but enough regulation to keep people safe from just losing their money by throwing it somewhere in the cyber world they don't even know where it's going. Yep.
I completely agree.
Hey, buddy, I really appreciate your time. I hope to have you on in the future, especially if something changes here in the market environment. We'd love to have you come on again and talk to our listeners and viewers again.
I'd love to do that, Coach Pete. You just let me know when.
Folks, his name is Laurence Black. He is the founder of the Index Standard, and we really appreciate your time today, Laurence.